How is everyone doing? Welcome to the Strategy Room on this Saturday night, September 19th, 2025. I hope everyone is having a great Friday night out there. I have a great show for everyone tonight. We're going to be going through a lot of stuff. We're going to be talking about the Federal Reserve's interest rate decision. We're going to be looking at what has happened to interest rates this week in terms of the bond market and the 30-year mortgage. We're going to be taking a look at potential future Fed interest rate decisions. We're going to be looking at the statement issued, or the press release rather, issued by the Federal Reserve yesterday. We're also going to be taking a look at what's, some of the big news of the day with TikTok, what's happening with that. We're also going to be going into a lot of banking news. I'm going to have a little bit of a real estate update for everyone in general, kind of what are some of the things happening in the commercial real estate or the investor market. So going to have a lot of stuff to go through here tonight. And I am going to kick it off as I normally do with the debt clock. So let's take a look here at what we've got. So again, still we're at now 37.5 trillion on the national debt scale. We are at 1.9 trillion in our national federal budget deficit. Now, the good news there is that it's actually come down a little bit. We were actually a little over 2 trillion. So we basically about $100 billion has been shaved off of that U.S. federal budget deficit, which is fantastic. The Doge clock now up to $639 billion and counting, with savings per taxpayer of $5,696, which is fantastic. And the debt to GDP ratio still remains at a very high 123%. We would very much like to see that come down. Now, obviously, a lot of the discussions going on in Congress this week, which will continue into the next few weeks, is basically what to do with the budget. Obviously, the federal government's fiscal year end is September 30th, and there's a lot to discuss, a lot to figure out between next couple of weeks. It looks like the Republicans are pushing through what's called a CR, a continuing resolution, to see if they can keep the government funded through September 30th and then, work for over the course of the next couple of months to get a budget ironed out. But the Democrats look like they want a whole lot of stuff and a whole lot more money in order to do that. Otherwise, they are threatening a shutdown. So we shall see what happens with that. But like I said, always like to give kind of just the overview to start with, because this usually conversations that we have here tie back into this in one way, shape, or form. So, but also, okay. First news story of the night. I want to start off with this. A few weeks back, I had reported that this poor banker for Wells Fargo had been detained by the Chinese government. I am very happy to report that the Wells Fargo banker who was detained by China is now free to return to the U.S. Some very good news. So Adam Boehler, special envoy to hostage response, said officials' actions show U.S. policy has changed. So, but let's just real quick here. So an American Wells Fargo employee detained by China via an exit ban earlier this year is now allowed to return to the United States. The Washington Post first reported the development, which came after U.S. and Chinese officials met for 2 days of talks in Madrid. Wells Fargo executive Mao Chenyu, if I'm saying that right, was barred from leaving China in July due to what Chinese authorities said was an ongoing criminal investigation. The bank has since suspended all travel to China. So during an event hosted by the Washington-based think tank Center for a New American Security on September 16th, Adam Boehler, U.S. Special Envoy for Hostage Response, said the United States did just get someone that was held in their home released from China. So Boehler did not give the name of the person released. The White House did not respond to a request for comment. It's unacceptable everywhere to do these things. China should know that. And I think we made it very clear, and they responded in a positive way from that perspective. I like that, but there's more to do, Boehler said. So again, very good news here. This individual released and is now free to return to the United States. So very happy about that. I was very happy to report that to everyone. Okay, now let's go in, and I'm just gonna blow this up here for a minute just for everybody to see this. So I will talk about this a little later when I get to that segment of the show, but one of the episodes that I did this week that came out on Monday was I talked about the bankruptcy, the total collapse of this subprime auto lender called Tricolor Holdings. People loved it. Great video, got a ton of views. People with a lot of great comments back on it. But I wanted to show this because this came out on Thursday, yesterday. So Zero Hedge reported. So meanwhile, in subprime land, things are having their Lehman moment. So we can see here tricolor auto securitizations, and it's just torpedoing down. And then I also have another article here from Zero Hedge, which unfortunately they decided to put behind a paywall. But the article was basically titled Subprime Crisis 2.0, Red Flags Fly as Alleged Fraud Triggers Billion-Dollar Auto Lender Bankruptcy. So this kind of builds on the episode that I did on Monday. So over the course of this week, the last few days, basically all the lenders involved in this whole fiasco, of which there are a number, and there's both, big banks, and so there's, JP Morgan, Barclays is involved with this, as well as some tiny banks like a bank called Origin Bank. So you kind of have a mixture of different banks in here. BlackRock is involved in this with securitizations of some of these loans. So again, a very interesting story here. Very surprising that the business news media has not really reported on this. There's really not a whole lot of reporting out there, which is, again, very surprising, because I think this is a very big deal. And I'm really surprised that, there hasn't been more made of this, because just because this has the ability to have a little bit of a domino effect. I'm not saying that this is going to run wild and banks are going out. I'm not jumping all those conclusions. I'm just saying that you've got hundreds of millions of dollars here that are really going to hit some banks, and it could get a little bit worse. We could run into the billions of dollars by the time this thing is over, which would not surprise me one bit. So, but like I said, I wanted to report on this. I just wanted to show this to everybody. And this is obviously a developing story. I'll keep an eye on it here over the next couple of weeks. But if you haven't had a chance to go see that episode on Tricolor Holdings, not that long, it's like a 15-minute episode, but if you get a chance, go watch it, because I think you'll find the whole story of this subprime auto lender very interesting. So, and like I said, I'll give a review of that episode later on in the show as we get to that. So, okay. What's our big news of the week here? Well, the Federal Reserve approves a quarter-point interest rate cut and sees two more coming this year. So we got a basically 25 basis point or 0.25% rate cut out of the Federal Reserve. So the Federal Reserve on Wednesday approved a widely anticipated rate cut and signaled that two more are on the way before the end of the year, as concerns intensified over the U.S. labor market, even as inflation is still in the air. In an 11-1 vote signaling less dissent than Wall Street had anticipated, the Federal Open Market Committee lowered its benchmark overnight lending rate by a quarter percentage point. The decision puts the overnight funds rate in a range between 4% and 4.25%. Newly installed Governor Stephen Miron was the only policymaker voting against the quarter-point move, instead advocating for a half-point cut. Now, I will get to that in just a second there. Now, we can see from the chart here, this is just showing the interest rate movements by the Fed, and you can see they're starting in 2022. They had their large interest rate hike cycle that petered out at 5.375. It remained there for a little bit. Then last year, at the end of 2024, they brought it down 100 basis points, which it has stayed since. And now they made their first quarter point rate cut since December of last year. So, okay, now let's get to the statement here for a second. So, just a couple things right here before I get into this. So the initial market reaction. So the S&P 500 was mostly unchanged. U.S. Treasury yields decreased by roughly 2 to 3 basis points across the curve, but then jumped up a little bit, as we'll see here in just a few minutes. The market is pricing in a 93% chance of a 25 basis point rate cut at the October 2025 Federal FOMC meeting. Now, again, that's not a shock or a surprise, because Jeremy Powell basically said that, hey, we're probably going to do two more rate cuts there. So not a surprise that they have a high probability like that on there. So the FOMC announces the following actions and analysis. This was an 11-1 policy vote, with the one dissent in favor of a 50 basis point rate cut. Now, what made that dissent, again, very interesting was the fact that, the previous month, going back to August, we had a couple dissenting votes because Jeremy Powell didn't cut the interest rate. Now we got a dissenting vote because Jeremy Powell didn't cut enough. So it's again, so kind of interesting. I mean, we haven't, and I only point that out because we haven't seen these things in a long, it's been a long time since we've seen, we haven't seen dissenting votes like this since Thomas Honig basically dissented back in 2010. So it's been 15 years. It's been a long time since we've seen these type of dissenting votes. Now, yeah, let's read the statement here, shall we? And I'm like, sorry, I got too many papers running around here. Okay. All right. So recent indicators, and you know what? Let me blow this up so everybody can see that. Oh, hopefully a little bit better there. How's that? That look a little bit better there. All right. Recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have slowed and the unemployment rate has moved up, but remains low. Inflation has made further progress toward the committee's 2% objective, but remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. The committee has gained greater confidence that inflation is moving substantially toward 2% and judges that the risks to achieving its employment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. In light of the progress on inflation and the balance of risks, the committee decided to lower the target range from the federal funds rate by 0.5 percentage point to 4 3/4 to 5%. In considering additional adjustments to the target range, oh, you know what? Oh my gosh, I'm reading this. I'm reading this and I'm going, this doesn't seem right. This is actually, yeah, I'm sorry, guys. I actually clicked on the September. This is from last year. So, all right, you know what we're going to do here? So I was going to show this to you guys anyway. So this is basically, here's what the Fed changed in their policy statement. So let's blow this up here. So here's a comparison, and we'll go through this. So hopefully I can, show this to everybody here so we can see in the red here what was changed. So let me back up for a second. Let me reread this. Okay, so let's try this again. Recent indicators suggest that growth of economic activity moderated in the first half of the year. Job gains have slowed and the unemployment rate has edged up but remains low. Inflation has moved up and remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate and judges that downside risks to employment have risen. In support of its goals and in light of the shift in the balance of risks, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4 1/4%. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. So there's the statement you have from the Fed. Now let's just take a look at some of these red highlights here for a second. So what got removed from basically the last statement to this statement? Well, we had in here, although swings in net exports continue to affect the data, that was taken out. We have job gains have slowed and the unemployment rate has edged up but remains low, got added. Labor market conditions remain solid was removed. Inflation has moved up. That was added. And so the committee is attentive to the risks to both sides of its dual mandate and judges that downside risks to employment have risen. So that was added. Its support of its goals and in light of the shift in the balance of risks was added. The committee decided to lower was added in there. So again, just a kind of a couple interesting things there. I think the biggest thing there was the sentence on jobs. Job gains have slowed and the unemployment rate has edged up. And then obviously adding in at the end there, and judges the downside risks to employment have risen, and in light of the shift in the balance of risks. So some little but big changes here in the text of what the Fed was pointing out here in this recent statement. So again, Fed acknowledging that the labor market has weakened, but they're also saying that basically, hey, inflation is edging up a little bit. So so they're leaving kind of a back door there to basically say, hey, we understand that the labor market is weakening, but we're also keeping our eye on inflation. So, all right, let me lower this down a little bit here. Okay, so here are 5 key takeaways from the Fed's big interest rate decision this week. So, let's run through here. Okay, so number 1, while the rate reduction was no surprise, there are plenty of intrigue over what the dot plot of individual members' expectations would show for the future. The upshot, 2 more cuts this year, another in 2026, and 1 more in 2027, all of which would take the funds rate down to around 3%, which the median forecast of the committee sees as neutral. Number 2, markets weren't sure what to make of it. An initial rally by the Dow Jones Industrial Average lost a little steam, but the blue chip index still closed up 260 points. However, the S&P 500 and NASDAQ both boasted losses. In the Treasury market, yields were lower on the short end, but higher for longer maturities. Potential problem for the Fed as it tries to avoid stagflation. Number 3, at least some of the confusion may have come from Powell characterizing the rate move as a risk management cut. On top of that, while the FOMC indicated a rapid pace of cutting this year with moves at the 2 remaining meetings in October and December, it anticipates just 1 reduction in each of the next 2 years and no cuts in 2028. The mix between dovishness and hawkishness left markets queasy. It's an interesting word there at the end. And number 4, the meeting began with a strong whiff of politics as new Governor Stephen Miron attended his first meeting after being sworn in Tuesday. However, Powell gave little indication of tension in the air. The only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and understanding of the economy. That's really all that matters. And that's how it's going to work, the chair said. And then finally, number 5, while Miron was the only member to cast a vote against the cut in favor of a larger half-point move, the dot plot showed a wide disparity among officials' views, underscoring a challenging policy path ahead. Those wanting just 1 more cut this year lost narrowly by a 10-9 margin against those looking for 2. Future years also showed a wide distribution of potential outcomes. So again, just very, very interesting there on some of these takeaways. Now, I mean, undoubtedly, Stephen Miron joining this meeting, absolutely sparked some waves there, without a doubt. And then let's go. Let's like I said, let's keep moving along here in some of these other articles. So Fed forecasts only 1 rate cut in 2026, a more conservative outlook than expected. So what I wanted to show you here was, in fact, the dot plot. This is what they were just talking about. And so if I can blow this up maybe a little bit so people can see this a little bit more. So again, you kind of see here, where people think we're at. So here's where we're at right here. We're at this, 4.2, 4% range here. So again, you could kind of see, a couple people look at it going down, but a lot more people going up. But then, you kind of come here to 2026 and then 27, and it gets to be, a little bit different story as to, perhaps the aggressiveness. Now there's one dot here, one little outlier. I think you could guess who that might be. That would be Stephen Miron right there. That little outlier there hanging out there. But again, this just goes to show you like how, perhaps contentious things are becoming inside the Fed there, inside these FOMC meetings, as you now have a couple, you got Waller, you got Mickey Bowman, now you've got Mirren, all basically, looking for, interest rate cuts, looking for reductions. You probably have a couple of the other Fed governors coming around to basically some rate cuts, as is shown here on this. But I think you still have a slight majority of Fed governors that are basically either very little or no rate cuts. And they're going to march to the drum of, Jeremy Powell. Now, and again, and I said this last week. I said that, Jeremy was, he was going to be very tough for him to get up and do these interest rate cuts this week. He was like, it's like I'd rather take a hot coal to the eye than put out those interest rate cuts. So he very begrudgingly got up there and made this 25 basis point cut. But again, is this now a couple things I just like to remind people here? Is this like the end all be all, this 25 basis point move here? No, it's not, I am actually with Stephen Mirren here. Could they have gone 50 basis points? Yes. And I think they probably should have, and then they probably should have gone just like the same thing they did last year. They probably should have gone 50 and then done, quarter point October, quarter point December, brought the rates down 1 point by the end of the year. Fantastic. Take a break in January, see how things are going, and then come back with a couple more quarter point rate cuts, take it down 150 basis points, done. This whole like, oh, we're going to do one more cut in 26 and one more cut in 27. Well, again, that's not quite aggressive enough. And that is, I don't think, going to make very many people happy. So, and I think that's part of why you got the mixed results here, is because even though the market was up a little bit, people also understand that, hey, we need more rate cuts and we need them a little faster. The Fed has already been stalling for, about 6 months here in cutting rates. So now it's like, okay, we got to get, we got to make this happen a little bit faster here, guys. So, all right. And then a couple more articles here on the Fed. So new Trump appointee Mirren calls for half-point cut in only dissent as rest of the Fed bands together. So the Federal Reserve Governor Stephen Mirren dissented from the Fed's decision to lower its key interest rate by a quarter percentage point on Wednesday. Mirren, the Trump appointee that the Senate confirmed to the Fed Board of Governors just a day before the two-day policy meeting kicked off, preferred a half-point cut. The governor was the sole dissenter against the Fed's decision. Now, I would remind people that Stephen Mirren he's only on here for a short period of time. He still has his other job. He's only got put on the Fed board. I think this is only good until January. So he's basically only here for 3 or 4 months, and then he goes out, and then the Fed will nominate his kind of like long-term replacement, as you will. Now, let's look at some of the other things. What are some of the other things that people said here? So the Fed's Kashkari, he advocates for 2 more rate cuts this year as he sees a limited tariff impact on inflation. So the Minnesota Fed president, Neil Kashkari, said Friday that he expects tariffs to exert minimum long-term pressure on inflation, leaving room for multiple interest rate reductions ahead. Kashkari said a weakening labor market combined with the muted impact of the duties give him reason to advocate for at least a bit easier policy. So he's one of the Fed governors that's basically coming around here to basically say, like, we're not seeing this huge inflation impact from the tariffs. We do see the weakening labor market. And as a result of that, we are willing to, cut the interest rates a little bit here. Now, again, I say a little bit because I think that's where their mindset is. Hey, we'll give them 75 basis points, maybe 100, but that's about all, all we're willing to give right now. Which again, I don't think that's terrible. I have said that I think the sweet spot is somewhere between 100 to 150 basis points reduction. I think that's the sweet spot. I just want the Fed to get there a little faster. I want them to move a little quicker here with these rate cuts. I don't think that, given with the issue with the job numbers, everything else that we've seen here over the last few weeks, we just need to see the Fed move a little bit quicker on this. So, okay, David Tepper says the Fed could cut a few more times, but easing too much risks entering dangerous territory. So, hedge fund billionaire David Tepper said the Federal Reserve could cut rates a bit more, but then risks more inflation and other dangers to the economy and markets if the central bank goes further than that. In other words, be careful what you wish for. If they go too much more on interest rates, depending on what happens with the economy, it gets into the danger territory, Tepper said Thursday on CNBC Squawk Box. You've got to be careful not to make things too hot. His comments come after the central bank lowered interest rates by a quarter point Wednesday, the first cut this year, while signaling two more reductions are coming later this year. Fed Chair Jeremy Powell characterized the cut as risk management rather than something more directed at shoring up a weak economy. Risk management. You gotta love it. It's like transitory inflation. We're gonna get risk management, everybody. Oh gosh, this is got risk management. I'm gonna have to remember that one. That's a good one. President Donald Trump has been pressuring the chief to slash the Fed funds rate quickly and aggressively. Yes, of course, Jeremy is, he just, anything he can to just, stick it to us, basically. It just, again, I mean, this is, believe me, everyone, he had to take the Advil. He probably had to take some Tums before he went out there to make that announcement. That's how brutal that was on him. He hates us all that much. Okay, so Hassett. Now here, Kevin Hassett, one of the basically one of the front runners to take Jeremy Powell's job, as it were. So Hassett says Fed made prudent call, signaling White House okay with a quarter point cut. So the Fed's decision to cut its key borrowing rate by a quarter percentage point seems to be sitting well with the White House, if National Economic Council Director Kevin Hassett is any indication. Assessing the economic variables at play and deciding on the incremental reduction was a proper move, said Hassett, who has been mentioned on the short list of Trump picks as the next Fed chair. Yeah, I will say this, Trump did come out with a tweet. I mean, I don't have that here, for it to show everybody here, but Trump did come out with a tweet right after this, basically just hammering Powell to no end, basically saying that, he should have cut it 100 basis points. He needs to move a lot faster. So I think a lot of people, I'll say it that way, I think a lot of people in the White House were very happy that hey, we got a quarter point cut. The Fed is signaling that there are going to be some additional cuts coming here over the next couple of months. So I think they could be, kind of happy that the Fed is now finally starting to move in the direction that they've wanted them to move in for the better part of the year. But is Trump happy with this cut? No, I don't think that Trump is happy with this. I don't think he's moving quite fast enough. But but Hassett, again. Hassett's trying to, he's trying to placate both sides here, trying to make both sides happy. Okay, so be it. So we'll see what happens there. Now, interesting article here. So Trump's Fed pressure campaign will lead to higher inflation, weaker growth, according to a CNBC survey. So Trump's Fed actions are designed to limit or eliminate the central bank's independence, according to 82% of respondents to the September CNBC Fed survey. The survey showed 68% think the president's actions will put downward pressure on inflation, and 57% say it will result in higher unemployment, and 54% see lower economic growth. The survey polls 29 of the nation's top money managers, investment strategists, and professional economists. Their responses were collected September 11th through the 13th. Again, is this a very scientific poll? 29 people? No, it's not. And I think, honestly, I think this is a garbage poll. I think they just put this out there for a headline. Because I think if you I don't know, if you polled 1,000 people, 2,000 people, I don't think that this would be representative of the type of data that you would really get back from a much larger sample size. But they present it almost like you can make generalizations from this, which you cannot. but I just want to point out there's some of the key things in terms of, that the people thinking that the president's actions will put upward pressure on inflation and will result in higher unemployment. I really don't think you're going to see this massive upspike in inflation. And I've said this before, will inflation remain elevated? Yes, I think perhaps inflation does remain elevated. Now, what does that mean? 3%, 3.1%, 3.2%, maybe. Do I see inflation spiking back up to like 4, 5, 6%? No, I don't see any of that happening. As far as the unemployment goes, yes, in the short term, over like say the next 6 months, we may continue to see unemployment, but there are so many things coming down the pike that I just have a really hard time believing that all of the growth, all of the deals that President Trump has signed, a lot of this stuff is going to start to kick back in. For people crying about the tariffs, I think, a lot of these companies need to start getting the message, and I believe they will, that, hey, look, this is a new day. A new day has dawned. Tariffs are a reality now, meaning if you don't want to pay tariffs, guess what you're going to have to do? You're going to have to start making stuff in the U.S. again. Okay. And if they want the stuff made in the U.S. so that they don't have to pay any tariffs, okay, then they're going to have to get on the people, maybe either the people supplying them with the product or the product they make. They're going to have to, hey, time to open up a new factory in the U.S., isn't it? And I believe a lot of that will happen, but it's going to take time. I think right now you have a lot of people either, pretending this is going to go away or pretending like, oh, well, this is just a few years and then Trump will be out of office and the next guy will come in and all this stuff will go away or whatever. I really don't believe that, because I think that, again, I'll say it this way. Trump is going to create a situation where you're going to have somewhere in the neighborhood of $500 billion to $1 trillion in income every year from tariffs. That's where we're going to end up. It could be 500 billion, could be 600-700 billion. Not really sure exactly what that number is, but it's going to be somewhere in there between 500 billion and $1 trillion. It's going to fall somewhere in that neighborhood. And when it falls into that neighborhood, it's too much money to leave on the table. And a big part of the reason that he was able to cut a lot of the taxes, or keep a lot of the tax cuts that have been in place for the last few years, is because he's got this revenue coming in from the tariffs. Now, any politician that comes in behind him, whether it's a Republican or a Democrat, they're not going to be able to just open-handedly get rid of the tariffs, because it's so much money. It will just, it'll be so much money, and you get addicted to this money for 4 years. And then now all of a sudden you're into 2020. Now you're sitting there 2028 or 2029, and you're sitting there and you're going, okay, all of a sudden somebody's going to come in and say, oh, we want to cut the tariff revenue. We want to get rid of that. No, you at that point, you would probably plunge the government into chaos, or either that, or people would basically just look at you like you're just the dumbest person of all time. Because why would you just arbitrarily throw that? Why would you just throw that away? So again, I think that this is a monumental shift in American policy that is going to withstand whether it's a Democrat or a Republican president. These things are here, and they're here to stay, because Trump is going to show how effective this is going to be over the next 4 years. And when we start to see the amount of money that comes in, it's not going to be easy to just dismiss it out of hand and say, oh, that's an insignificant amount of money. No, it's going to be quite significant. It's going to be quite significant to the amount of money coming into the government every year in and year out. All right. I digress. I'm off there. So, okay. Now, another interesting aspect coming into this meeting was the whole drama around Lisa Cook, as I have reported on. Now, coming into the meeting, it was basically Trump got told by the federal appeals court that he could not fire Lisa Cook, or at least he could not fire her before this meeting. So this federal appeals court ruled that Donald Trump cannot fire Federal Reserve Governor Lisa Cook before the central bank's policy committee votes on whether to lower interest rates. The ruling means that Cook, a member of the Fed's board of governors, can participate in the pivotal two-day meeting starting Tuesday morning, which she did. And then the update on this one is Trump takes Cook firing to the Supreme Court. So Chief Justice John Roberts asks the Fed governor for a response by September 25th. The U.S. Solicitor General, meanwhile, said lower courts have interfered with President Trump's right to remove Cook. So the Trump administration asked the Supreme Court on Thursday to immediately allow the president to fire Federal Reserve Governor Lisa Cook while the case against her continues in appeals court. Chief Justice John Roberts, meanwhile, asked for a response from Cook by September 25th. Arguments in the case will be held November 5th. A decision is likely to come before the end of the Supreme Court's term next summer. Cook's removal could precede any decision the justices issue, Solicitor General John Sawyer wrote Thursday. That the Federal Reserve Board plays a uniquely important role in the American economy only heightens the government's and the public's interest in ensuring that an ethically compromised member does not continue wielding its vast powers, Sauer wrote. Sauer argued that lower courts ordered blocking Cook's firing by President Donald Trump mark yet another case of improper judicial interference. So again, we'll have to see. Again, this drama is going to continue to play itself out. So Chief Justice John Roberts, he wants to hear from Lisa Cook by September 25th. And then I guess we'll find out if he's going to rule on this or if, what ultimately they're going to do. They could rule on it by November 5th. But we'll have to see what happens. My guess is that this will not drag out until November 5th. My guess is that John Roberts might say something to the effect of, he's going to wait to hear from Lisa Cook. And then he might say something to the effect of like, well, I'm going to make this kind of rule and I'm going to kick it back to the lower court. And the lower court is going to have to make a decision based on evidence and things that have been presented to it. So that would kind of be my guess, but I don't know. We'll see. We'll have to wait to see what happens there with that. So, okay. And then additional comments here. So Stephen Mirren says that he doesn't see tariffs causing inflation, putting him in the minority on the Fed committee. So we got this stuff here. So Federal Reserve Governor Stephen Mirren told CNBC on Friday that he doesn't anticipate President Donald Trump's tariff will cause inflation. The governor also said he believes Trump's border policies will give rise to disinflation. Very interesting. Earlier this week, Mirren dissented against the central bank cutting its key interest rate by 0.25 percentage point. So what does he have to say here? I'm clearly in the minority and not being concerned about inflation from tariffs, he said on CNBC's Money Movers. But that was also true in 2018 and 2019, and I think I probably could take a little victory lap about that. There will always be relative price changes, but whether or not it's inflation that's microeconomically significant of the type of monetary policy should respond to is a different question, he added. His comments come after the Fed governor was the lone dissenter. When explaining the reason for his decision, Mirren said he doesn't see any material inflation from tariffs. I see no evidence that it's occurring, the policymaker said, pointing to the lack of difference in inflation rates between import-intensive core goods and overall core goods. If you thought tariffs are driving inflation higher, you'd think imports would be differentially inflating at a higher pace. Mirren additionally cited no discernible trend difference between U.S. core good inflation and that in other countries. If I thought that tariffs were driving any material inflation in the United States, I'd look for evidence, he continued. So again, some interesting comments here by Stephen Mirren. I don't disagree with him. I think it's perhaps a little bit more complicated than what he's stating there. And again, I have always said that you have to understand, you have to understand a crucial point here. There is only one thing that creates inflation, and one thing only, and that is government spending. If I could go again, I love to go back to my debt clock here. Okay. See this big 37.5 trillion in national debt here. See this 1.9 trillion in our federal budget deficit. That's 1.9 trillion that we're overspending each year. Okay, this is what causes inflation. The government spending, this is what causes inflation. Tariffs do not cause inflation. Tariffs may cause an increase to goods. They do not cause inflation. It's two different, a price increase because your costs went up is not the same thing as inflation. Inflation driving the overall cost of everything up. It's two completely different things. So you gotta keep that. And I think that is what Stephen is trying to talk about here. He just, he put it in a much more, highly technical verbiage there, as it were. And again, that's basically what he's trying to say there is that, hey, look, what we're seeing is that a lot of these companies so far are eating the cost of the tariffs and not driving the prices up, which is, hey, great. It's fantastic. It's good for us, right? But we are seeing a little bit of leakage in price increases. Like we are seeing a little. I've presented evidence of that over the last few weeks. A couple articles basically saying that a couple things have seen price increases, but it has been very mild. It has been very mild to say, or mild to nothing to say the least, as of this point. But is that not to say that they won't try to pass on some of this cost in the future? Well, I think that all depends on how good or not good the economy is doing. And I have said that I've also presented evidence that you've had some companies that have tried, fast food companies, McDonald's, other companies that have tried to pass costs on more recently, and it hasn't worked out so well for them. They've got, their sales declined further, or they got a lot of blowback from customers or consumers. And, so that's what we're seeing right now in this inflation world. You're seeing a lot of companies eating the tariffs, and you're basically seeing it being very difficult for them to pass on costs to the consumers, even if they want to right now. Very difficult for them to do so. So, but again, I agree with him on the fact that, I don't see this massive influx of inflation coming from tariffs, and again, I think it's very disingenuous. I really wish they would just say like price hikes, price increases from tariffs, not inflation. They so want to tie inflation to the tariffs, but not understanding like that's not how it works. That's not how it works. All right, now I want to talk about the jobs data for a minute. Now, obviously, I reported on this a lot last week about how, we got this major revision, almost 1 million jobs revised to the jobs data. So I want to show this to everybody. So I saw this article this week. I thought this was really interesting. How flawed jobs data influenced the Fed rate policy. So a recent big revision to jobs data has cast doubt on the government's data collection methods and raised questions about the Fed's interest rate decisions. So, accurate information on the jobs market and inflation is critical for U.S. policymakers. It's the core mission of the Bureau of Labor Statistics, the BLS. In recent years, the Bureau has faced scrutiny over claims that its job data may be unreliable and biased. That pressure intensified on September 9th when the BLS issued its largest ever revision, retroactively lowering job growth by 911,000 jobs for the 12 months that ended in March of 2025. The Trump administration criticized the revision, which shows that the U.S. economy added nearly 76,000 fewer jobs per month than first reported, mostly under the Biden administration. Now, I wanted to show this chart here because you could see these are the annual downward revisions. Now, and I would say that even some of these probably need to be looked at because this massive increase of 462,000 jobs in 2022. Yeah, I'm calling BS on that. I don't see it. I don't see that. I think they need to go back. I would be willing to venture. So you had in 23, it was negative 306,000 jobs. In 2024, it was negative 818,000 jobs. And now in 2025, it's negative 911,000 jobs. So if we add those up, these last 3 years, okay, that is 2 million jobs that did not exist. I mean, now think about that. If we saw that for the last 2 years, of the Biden presidency, if we saw the real numbers being presented in the jobs data and not the BS they were giving us every month, we would have a totally different outlook on the economy. And the Fed probably would have been cutting rates a lot sooner this year if we had been given or seen the real numbers. And I mean, this is I mean, you cannot downplay how big this is. I mean, this is a very, very big deal. This affects everything, because now it paints a vastly different picture of the labor market than what we have been, thinking that the labor market was. Which influencing the Fed's rate decisions, as it should, because now we're getting a clearer picture of what the labor market actually looks like, and it's not that pretty. But again, you could see here that especially for the last 2 years of the Biden presidency, the job market was abysmal. It was abysmal based on these numbers. 2 million jobs that basically never existed over the last couple of years. I mean, it's just it's incredible. President Donald Trump was right. Biden's economy was a disaster and the BLS is broken. White House Press Secretary Caroline Leavitt said on September 9th. On the same day, Trump posted on Truth Social, quoting Jay Hatfield, CEO of Infrastructure Capital Advisors, who told Fox Business, "The entire organization is broken. It needs to be fixed. They need to use modern sources of information." Hatfield said that if the Fed had followed what we published, they would have raised rates in early 2021. The BLS plays an important role in shaping the Federal Reserve's monetary policy, as its monthly reports on payroll growth, unemployment, and wages feed directly into the central bank's view of the labor market. Strong employment data can prompt the Fed to raise interest rates to rein in inflation, while weak numbers may lead to rate cuts aimed at stimulating economic growth. Because these decisions directly affect borrowing costs for households and businesses, from mortgages and auto loans to business refinancing, the accuracy and credibility of BLS data are essential, according to experts. Let me say it again. BLS data is essential, according to experts. Problems in data not only risk misleading policymakers, but can also disrupt markets and impact economic activity. Yes. And this falls to the next thing. Why I think there is a very good case to be made that the former BLS chief, who was just fired, maybe should be prosecuted for what she did. Because this is, and I went on a little bit of a rant on this last week, but I mean, this is monumental. Like, you can't downplay this. Like, this is huge. Like, companies make decisions off this economic data. They look at all these economic indicators to try this. That's why I talk about this stuff every week ad nauseum, because this stuff is really important, and you can't base all your decisions based on one economic indicator. You got to look at a number of them, and by looking at a number of them, it gives you an overall picture it paints a picture for you of overall what's happening in the economy. And again, those numbers aren't perfect. They never were, and it is totally typical, totally natural to get revisions on, you get the new numbers for the month and you get some revisions to last month's numbers. But it is also very normal for those numbers to fluctuate, meaning that they can go up and they go down, but they can also go up too. The problem is, for the last couple of years of the Biden administration, when almost 90% of the time you would get some headline number, like you'd come out and say, "Oh yeah, jobs went up by 250,000 jobs last month. Great. It looks like the economy's doing great." And then the next month comes and you get, "Oh, jobs increased by another 225,000 this month." But the last 3 months jobs numbers were revised down by 150,000, 100,000, and 75,000 respectively. Like, wait, what? So and again, you can't have that, because it distorts the economic reality, and then people start making really bad business decisions based on these numbers that are in front of them. Now, I said for the last 2 years of the Biden administration, I said, you also have to rely on the eyeball test. What do your eyeballs tell you? Like, I'm reading the Wall Street Journal every day, and I'm opening the Wall Street Journal and I'm looking at it. I'm going, this company's cutting 10,000 jobs. This company's cutting 5,000 jobs. This company's counting $20,000. This company's cutting this. This company's cutting that. And that's all I see. I see zero articles, zero of, oh, this company's hiring 10,000 people. This company's hiring 5,000 people. This company's hiring 3,000 people. Zero. And I sit there and I'm looking at it. I'm going, so where's all the job growth coming through? Well, a lot of it was going into the service sector where a lot of, illegal immigrants were being hired to do a lot of those jobs. It was also going into government jobs and to healthcare jobs. And the healthcare jobs were also being funded by the government. The money from government was going into healthcare and fueling their ability to be able to hire people. That's where all the job growth was coming from. It wasn't coming from, the overall growth in the overall economy. So again, I just point this out because it's such a big deal. And I hope that EJ Antoni is coming in here, and I'm really hoping that he could get grab the bull by the horns here, and he can hopefully get this, straightened out. And hopefully we can work on maybe changing some things up so that this kind of stuff does not happen again in the future. I'm not going to hold my breath, but hopefully not. So, okay. Now, another interesting take here. So the Federal Reserve predicts that higher inflation will persist for more than 7 years post-pandemic. So the Federal Reserve's latest set of projections foresees inflation as measured by core PCE prices falling to a 2% annual rate by the end of 2028. If the Fed's assessment is accurate, inflation will have run above the Fed's target for more than 7 years. The projections highlighted the central bank's struggles to wrestle inflation down to its target as tariffs push up consumer prices. Now, I just want everybody to think about that for a second. So they're saying here that inflation will remain elevated until 2028. So it's elevated. So again, meaning that it might hang up there at 2.5%, 3%, maybe a little over 3%, whatever. But eventually it's going to come back down to its 2% target. And we're probably about 2.5 years maybe away from that. I think that it can happen a little sooner. But we'll see. I think there's a good chance that inflation could come back down over the next year and a half. I think could be a little bit more accurate. But again, just to point this out, so they're saying here that basically we got until 2028 for a lot of this inflation to remain more elevated. Okay, so why the Fed rate cuts won't ease the government's debt problem. So move will likely reduce U.S. borrowing costs for short-term treasury bills, but annual interest expense won't shrink that much. So the U.S. government spends about $1 trillion annually on interest. The Federal Reserve just lowered interest rates. That means the U.S. will reap huge savings, right? Well, not really, and here's why. So yes, the Fed's quarter-point cut will likely reduce U.S. borrowing costs for treasury bills that get issued frequently. Those have durations as short as 4 weeks. So rates that move with the Fed's target rate can show up quickly in lower government costs. But almost 80% of federal debt is composed of notes and bonds with terms that were originally between 2 and 30 years. Those interest rates were generally locked in when they were sold. Even if long-term rates immediately reflected the Fed's cut, it would take years for new debt with cheaper borrowing costs to replace maturing notes and bonds. You're not going to drastically change budget deficits that are approaching $2 trillion, said Jessica Riedel, senior fellow at the conservative-leaning Manhattan Institute. It's too small of a rate change on too small of a share of our total debt. So, yes, she is right and she is wrong. Okay, so let me explain what I mean by that. Yes, they are correct. We do have longer term bonds that are locked in for longer periods of time. It does take years for that to cycle out. However, in a certain respect, Janet Yellen, former Treasury Secretary, she did us in an interesting way. It was terrible. I would call it a terrible gift. See, she did this thing last year in order to keep the Treasury yields down. In order to help her boss, Joe Biden, try to get reelected last year, she dumped trillions of dollars into, wait for it, not long-term Short term. She dumped them all into the short term. So we have a quarter of our national debt that had to get refinanced this year. So she is right that a lot of bonds are priced out longer on what's called longer on the yield curve. Okay. However, we have a ton. We have almost $9 trillion. Now, a chunk of that has already been refinanced this year, but a big chunk of it still needs to be refinanced. I think Scott Bessent has done a beautiful job of basically managing the treasury market and managing the bond and treasury sales. I think he's done just an outstanding job this year of managing that whole process and making sure that things are continuing to function properly. And as a result, what we've seen is we've actually seen the rates actually come down over the course of the year, which has been good. I think the 10-year treasury is down about 45 basis points from the start of the year. So we are seeing that. But I also agree with them here that the rate cut is not enough. A simple 25 basis point rate cut, it's a reality. It's not enough to really move or have any kind of a dramatic effect on anything. That's why I said they need to bring the rates down 100 to 150 basis points. If you bring the rates down by that percentage, that does make a huge difference. And remember what they're talking about here at the beginning. The U.S. spends $1 trillion annually on interest. Well, what is that? Well, it's this. Again, going back to the debt clock here, it is this $37.5 trillion. It costs us $1 trillion a year just to service this debt. And now keep in mind, that is just interest. There's no principal. That national debt is not getting paid down by 1 cent. It just continues to go up and up and up. So all we are doing right now is paying the interest on the loan. This is like, think of it like you have a credit card that has a balance of $37.5 trillion. And that balance keeps growing every year, every minute, as a matter of fact, because you just keep spending money that you don't have. And so that, and basically every month you're just making the minimum interest payment on that credit card. You're not paying any principal. That is what is happening. So again, a couple of things there that I would just add to this is I would just say that if they can get more aggressive with the rate cuts here, it will help us because we do have a huge chunk of debt that we can roll over, and you will start to see that $1 trillion in national interest expense. You will begin to see it come down. Is it going to come down a lot? No, but you might be able to get it back down to maybe 900 billion or 850 billion, something like that, something in that range. But again, that's still 100 billion, 150 billion that we don't have to spend today. So again, just like I said, just some interesting points there I wanted to point out. Okay, this was pretty funny, and this is why I like Scott Bessent. So Scott Bessent quips about his reported threat to punch Bill Pulte in the face. So Treasury secretaries have a history of dueling. That is a very nerdy historical economics joke, if you get it. So if everybody, their love fest with Alexander Hamilton, with the play Hamilton and all that. If everybody remembers, Alexander Hamilton, our first U.S. secretary, famously died in a duel. That's what the joke is. Okay, so if you get this, so if you get that if you get that Hamilton had famously died in a duel with who was it? William Burr. And he got shot, he died. And so again, Bessent's just having some fun there. Obviously quipping that, hey, Treasury secretaries have a history of dueling. So I dig it, man. I dig it. As a finance nerd, I dig it. A lot of people, my wife would kill me for that. She'd be like, nerd. All right. So let's get into mortgage rates for a minute here. I wanted to show you guys where some of these bond yields are at. I also wanted to show you what happened to mortgage. So, rates got cut this week. So what happened with the mortgage rates? I want to kind of explain that for a minute. So, but first, so let's take a look at a couple things here. So the 30-year bond is sitting at 4.746%. So that has jumped up a little bit here. The 10-year Treasury note. Now, again, initially, it on the Fed's rate decision, it dropped down a little bit, but then it jumped back up. It's now currently sitting at 4.131%. Now, let's just go to the 1 year. So we can see here in January, we were up at about 4.793, and today we're hovering down about 4.131%. So again, we're still looking very good. This has had a positive net effect, but again, people were panicking because of the effect of what we saw last year. If again, just to remind everyone, last year, if everyone remembers, we had something historical happen that had never happened before. The Fed cut rates 100 basis points, and then the 10-year Treasury note increased 100 basis points. So effectively negating the whole exercise. So it was almost as if the Fed did nothing in a certain respect. But again, the rate started to jump up a little bit after the Fed, cut this rate, and everybody's like, oh, see, look at this, it's the Treasury yield's gonna jump up, and this is not bad, whatever. So, and I would tell people a couple of things on this. So, number one, and I want to go back down. Let's look at the 5-day here for a second, right? So, the 5-day had been coming down. We were at 4.088, and then it had gone down to, if I could touch on this, 4.005. So it had been going down a little bit there. Why was it going down there? Well, it was going down because the bond market had already priced in this interest rate cut. This was already priced in. That's why it was going down. And then, of course, when they make the cut, then that has a tendency to spike it up a little bit, so it jumps up a little bit. But I believe that it will calm down a little bit from here. It may take a week or two. And like I said, as I do the show over the next couple of weeks, you guys could track me and you could basically say, hey, Joe, you were right. Hey, Joe, you were wrong. I think, very, very, very interesting. I think I got some comments here, but I'm trying to see, can I see these comments? Okay, no, wasn't. All right, so these are, sorry guys, I thought I had some comments here, not really anything here I'm really understanding. So we'll come back. So if it's a gentleman named Kenny. So Kenny, if you want to put some comments in there, please do so. I'd be happy to try to answer, some of the questions here for you, or whatever your questions you have there. So, okay, like I said, I'll keep an eye here, see if you plug some of these things in. So, but anyway, as I was saying, so I do believe that this rate's going to continue to creep down. Now, will it drop much below 4%? That I don't know. That we'll have to wait to see. I think 4% it's not just a floor. It's also a little bit of a psychological barrier there, if that makes sense to people. So we'll have to wait to see what happens there. But will it creep back down toward 4%? Yes, I believe it will. Like I said, it might take a couple weeks, but I think it will eventually bring its way back down. Now, let's take a look. What's going on with some of the shorter term bills? So the 1-year bill is at 3.591, the 6-month at 3.842, the 3-month at 3.976, and the 1 month at 4.068. Kind of right, I would say, kind of right where we want them to be right now. So nothing too crazy there. And again, we are still seeing as the 10-year is sitting at 4.13. The 2-year note is at 3.548, so almost a 50 basis point spread there. So again, we are continuing to see what's called a steepening of the yield curve, which is good. That's exactly what we want to see. So now let's take a look at mortgage rates here. So this is as of today. So the 30-year rate is steady at 6.23%. So mortgage rates are unchanged and still under 7%. Today's national average on a 30-year fixed rate mortgage is 6.23%, according to Bankrate. If you choose a 15-year fixed rate mortgage, the average rate was 5.41. I'm going to try to make this a little bit bigger here, so hopefully everybody can see this. The Federal Reserve lowered the federal funds rate by 25 basis points on Wednesday and signaled that more cuts could come later this year. Mortgage rates dropped in the weeks leading up to this announcement, and they could fall further this year if the Fed continues lowering its benchmark rate. So top mortgage rates today. So we could kind of see here if we jump down here. So today's average mortgage rate, 30-year, 6.25%. Last week's average was 6.33, so it was down 0.10%. Again, 15-year looking strong at 5.41%. It's fantastic. A 5/1 ARM is at 6.04%, and the 30-year fixed jumbo is at 6.32%. So again, not too bad at all. I mean, again, at the beginning of the year, we were looking at 7%, a little over 7% residential mortgage rates. We've now gotten that down to about 6.23%. And the Fed, now keep this in mind, the Fed decreasing the rates is going to help, but a lot is also going to depend on the mortgage market. That is a big, big key to this whole thing. So here's another article here. So what decides where mortgage rates go from here? So while the Fed has begun cutting rates again, there are many other factors that affect the cost of home loans. So with the Federal Reserve in cutting mode, many people expect mortgage rates to fall fast. Unfortunately, it isn't that simple. The Fed sets a target for a short-term overnight interest rate. Lots of other borrowing rates are priced off that baseline, but mortgages aren't one of them. Instead, a key benchmark for mortgages is the yield on the 10-year U.S. Treasuries. Yes, as I've said before, everything in your life is tied to the 10-year Treasury. Your credit card rates, your auto loans, your student loans, your residential mortgages, all tied to the 10-year Treasury. Now, it is true, the Federal Reserve, the federal funds rate, does it have an influence on the 10-year Treasury? It does, but does it directly affect it? It does not. So, but anyway, so since that is about the expected amount of time a home borrower might hold a 30-year mortgage before moving or refinancing, the yield on those notes helps determine the price investors pay for bonds that pool many individual mortgages. True, the Fed can influence the yield on that longer dated paper through its current short-term rate policy, economic projections, and jawboning. Longer-term Treasury yields and mortgage rates had been falling in anticipation of the Fed's move Wednesday to cut rates by 0.25 percentage point. Yes, as I just pointed out a few minutes ago. Even so, how things play out longer term is ultimately in the hands of investors, and they might not want to lower their demands for yield over a number of years because there is another crucial thing they have to consider: inflation. Regardless of what investors think the Fed might do with rates in the near future, investors are also worried that being paid a fixed rate on today's investment isn't going to be enough to keep up with inflation. The risk is that the same interest payment years from now might buy a lot less. This can lead to a confounding move. A year ago, for example, the Fed surprised markets by lowering its benchmark rate by 0.5 percentage point at its September meeting over the next 2 years. The 10-year Treasury yield rose by about 0.5 percentage point, and average mortgage rates jumped about 0.75 point. That isn't to say markets in coming months will respond to the Fed's latest move in the same way, which they will not. Perhaps the current feeling is that inflation is mostly under control and the bigger risk is job losses due to a slowing economy. In that case, lower rates might not put as much upward pressure on prices, causing inflation fears to recede. That, in turn, could lead to lower mortgage rates, reviving home buying activity and more housing supply that helps keep home prices in check. But investors who buy mortgages, corporate debt, or U.S. Treasuries that last for years and years are thinking way beyond what will happen at the Fed's next meeting. The result is that, historically speaking, changes in the Fed's benchmark rate targets barely are correlated with changes in home borrowing costs, according to strategists at Morgan Stanley, who compared prior changes in Fed rate policy to changes in mortgage rates. We would argue that if the Fed simply does what the market expects, mortgage rates will not fall materially. Status wrote in a note. That's not to say the Fed is powerless. Home buyers and investors can't ignore the politics currently swirling around the central bank. In theory, this means a future Fed might give priority to aims such as promoting the housing market via lower home borrowing rates. It is within the Fed's toolkit, for example, to buy mortgage bonds, one variety of a maneuver known as quantitative easing, following the 2008 financial crisis, for instance. Now, do we want to go back down the quantitative easing path? I would say no, because a part of the Fed's problem today is that they way overdid quantitative easing for a lot of years, and they basically twisted and morphed and contorted the market into places that they never intended to. And that is what has led us today. All that market manipulation. I would say, no, we really don't want them to do that. But there is another thing that they could do. So right now the Fed has been trying to decrease their balance sheet. So they've been selling a lot of bonds on their balance sheet, running off the balance sheet, as it were. And they could basically stop that. That doesn't mean they have to start buying again, but they could basically just sit tight and say, you know what? Okay, we're just not going to do anything for right now, and we're just going to sit pat. That in and of itself may help to massage the situation a little bit, as it were. But again, Jeremy Powell is thinking legacy, and he knows he's only got, a few more months left until he's given Das Boot. And so, he's trying to do everything he can to try to bring the balance sheet down so that basically when he goes to write his memoir book, he can basically say, oh, look what I did. The balance sheet jumped up to $9 trillion, but I did everything to try to bring that back down. Okay. But again, I just use this to point out the fact that there's more to the mortgage rates than simply the Federal Reserve. But again, if you look at it's all of these things together, right? You have fiscal policy and monetary policy. And, the fiscal policy coming from the United States government, that is the spending and the taxes. We have to get, we've kind of got the tax thing taken care of, but we still have a major spending problem. So we got to get the spending problem taken care of. On the monetary side, you have, the Treasury and you have the Fed. Well, the Treasury, Scott Bessent's been doing a fantastic job over there, and he's been handling things as best he can. But the Fed has not been playing ball. The Fed has not helped one bit this entire year. Now we're finally getting a tiny little bit of cooperation out of the Fed. And that's great, but we need a lot more. And like I said, if we can finally get to the day where, the government side of the equation on the fiscal policy and the monetary side of the equation with the Treasury and the Fed, when we can get to a point where that's all working and rowing the boat in the same direction, we are going to get some amazing results. We are going to get a lot of things rolling in the right direction here, but that takes a while. And in the short term, when you're trying to fix a mess, in the short term, you're always going to feel some short-term pain. That's just the way it is. And that's really been what this year has really been all about. All the bumps has really been, dealing with trying to correct the giant mess left to us by the Biden administration. Okay. And then I think this is one last article. Oh, no, let's see here. Now that the Fed cut rates, should you refinance? Experts weigh in. So the Fed's long-awaited rate cut could bring some consumer rates down, which may be good news for borrowers hoping to refinance into lower-cost loans. But whether to refi existing mortgages, car loans, or student debt into lower-rate alternatives generally depends on the type of loan and your financial picture, experts say. Yes, I would concur with all of that. And what I would say to people right now is, I would say just wait a little bit. Just be patient. I would say wait till the end of the year. I'd say the Fed's going to cut a couple more times. That'll be 75 basis points by the end of the year. Let's wait to see how all that looks. And then let's wait to see what the 10-year Treasury, coming back to the 10-year Treasury for just a second here. Let me, okay, let's see here. 10-year Treasury right here. Let's just keep an eye on this, and let's just see what happens here with this 10-year Treasury. Because this is going to be the big thing, right? This is going to be the tell of the tape. So let's just keep an eye on this over the next 3 or 4 months. Hopefully this drops down to 4%, a little below 4%, which means that hopefully the 30-year mortgage rate might creep down to like 6%. Good news. If you're sitting for some reason, if you're sitting at 7%, or you're maybe a 7.5 or something like that, like then that might be a great time to refinance. So, but we'll see. Interestingly enough, mortgage refinance demand spikes nearly 60% as interest rates drop sharply. So the average contract interest rate for 30-year fixed rate mortgages with conforming loan balances of $806,500 or less decreased to 6.39% from 6.49%. It's even a little bit lower now. As I just pointed out, the adjustable rate mortgage share of activity increased to 12.9% of total applications, its highest level since 2008. Now, what do they mean by adjustable mortgage rates? Well, they mean this right here, the 5/1 ARM. 5/1 ARM is what they're talking about. So the average loan size on refinances reached its highest level in the 35-year history of the MBA's tracking. So, applications to refinance a home loan jumped 58% last week compared with the previous week and were 70% higher than the same week 1 year ago, according to the Mortgage Bankers Association's seasonally adjusted index. The refinance share of mortgage activity increased to 59.8% of total applications from 48.8% the previous week. This as the average contracted interest rate for 30-year mortgage rates dropped. Homeowners with larger loans jumped first as the average loan size on refinances reached its highest level in the 35-year history of our survey, said Mike Fratantoni, Senior Vice President and Chief Economist at the MBA. Refinance applications were particularly strong for adjustable rate mortgages. The ARM share of activity increased to 12.9% of total applications, its highest level since 2008. Notably, ARMs typically have initial fixed terms of 5 years, 7 years, or 10 years, so those loans do not pose the risk of early payment shock that pre-2008 ARMs did. Borrowers who opt out for an ARM are seeing rates about 75 basis points lower than for 30-year fixed-rate loans. So again, very interesting. So the rate has come down. We are seeing a little bit of a spike in mortgage refinances, which is good. And I would just tell people like, hey, let's just keep an eye on this over the next few months and let's see what happens. So, really interesting article here. I'm going to come back to this in a few minutes. This came out and I really wanted to cover this. This is how people actually use ChatGPT according to new research. So I'm going to show everybody this in a few minutes, but I'm going to come back to that as we're going to blow through a lot more banking news. So, okay. So this is the part of the show where I like to give you guys the economic indicators coming up for this week. I like to talk about the 5 episodes that I put out this week. I also want to share an article from the Wall Street Journal with everybody. But first, let's go to the episodes that I put out this week. So up first, on Monday, I put out potentially massive fraud at Tricolor Holdings, which is a subprime auto lender. So this episode reviews a series of articles from S&P Global Market Intelligence detailing the events of the last week as a potentially massive fraud was uncovered involving a subprime auto lender named Tricolor Holdings. The fraud is alleged because, as of yet, no criminal charges have been filed, but the potential losses are currently rippling through multiple banks, including JP Morgan and Fifth Third Bancorp. So again, if you're interested, check that out. Like I said, that was a very popular episode this week. A lot of people jumped on that. We got a lot of comments, a lot of great feedback from people on that one. So people really loved that one. On Tuesday, I did credit union purchases of community banks are harmful. So a new analysis from ICBA shows that credit union purchases of community banks do in fact have a harmful economic effect on the communities which they mean to serve. This episode reviews an article from ICBA titled, "New Analysis Shows Credit Union Acquisitions of Community Banks Harm the Communities That Can Least Afford It." The analysis looks at the impact of SBA lending and residential mortgage lending in various communities after a credit union purchased a local community bank. So again, very interesting article. A lot of heat turning up on the whole, should credit unions have the tax exemption that they have? Maybe, maybe not. We'll see. Then on Wednesday, I did a very interesting episode, the history of the New York Stock Exchange. So a lot of people might wonder a little bit about the New York Stock Exchange, like how did it start? How did it evolve into what it is today? So this episode takes us through the humble beginnings of Wall Street in the 1700s, through the 18 and 1900s, and into the 2000s. The episode reviews an article from the Wall Street Journal titled "A History of the New York Stock Exchange's Ups and Downs." And that article had some incredible pictures in it. I'm definitely a history buff. And, just a lot of the, like some of the pictures depicting the Bretton Woods Agreement, which was the original kind of formation of the New York Stock Exchange. And then, just different pictures of different things from the 30s, 40s, 50s, stuff like that. Pictures of Wall Street back in like the 1860s and 1870s, which I think is, really fascinating to me. And I was hoping other people would find it interesting too. Then on Thursday, I did an update on billionaires in the U.S. So the U.S. now has over 1,000 billionaires. And this episode looks at who some of these billionaires are, what their net worth is, and where they live. The information covered in this episode comes from an article on the Wall Street Journal titled "What We Know About America's 1,135 Billionaires." And then finally, today, came out earlier today, I did the Treasury Secretary Scott Bessent strikes at the Fed. So Treasury Secretary Scott Bessent has unleashed on the Fed in his new article, "The Fed's New Gain-of-Function Monetary Policy." The article discusses the Fed's potential loss of independence, widening inequality in America, how the Fed's actions have distorted the market, and ends with a call for reform. This article is monumental and historic. Change is coming to the Fed, whether they like it or not. And I would encourage everyone to check that article out. I did cover that in the live stream last week. I did get a couple questions from people about it after the fact. So that's why I wanted to do an episode just dedicated just to that article. I just wanted to cover it. But it is monumental. And it is historic. And the reason being is because, we, in our lifetime, we have never had a Treasury Secretary come out and openly challenge the Federal Reserve and basically call for major auditing and major changes to the Fed. We have not seen that in our lifetimes. And so it's historic from that perspective. It's monumental because it points out all of the mistakes made by the Fed. And again, shameless plug here for my Lords of Easy Money series. But if you have not read the book, The Lords of Easy Money by Christopher Leonard, you have to go read that book. That book substantiates everything that Scott Bessent said in that article. So go read that book. Go watch my series. Go watch my interview with former Kansas City Fed Governor Dr. Thomas Honig. Dr. Thomas Honig is the main character of the book, The Lords of Easy Money. So go and, like I said, go look at that series. I'll actually put a link to it at the end of the live stream tonight. So but go look at that series. Go check the book out. You'll have a much better. You don't need to do all that to understand what Scott Bessent is talking about in the article, but it dramatically helps. It dramatically helps. So, okay. So those were the 5 episodes that I put out this week. So what do we got as far as economic indicators coming out this week? So, okay. On Tuesday, September 23rd, we have a current account. We have the manufacturing PMI, the services PMI, the 2-year Treasury note auction, and the API weekly crude oil stock. On Wednesday, September 24th, we get the building permits. We get new home sales, the 5-year Treasury note auction. On Thursday, September 25th, we get continuing jobless claims, durable goods orders, GDP, goods trade balance, initial jobless claims, existing home sales, the 7-year Treasury note auction. And then finally, on Friday, September 26th, we get the core PCE price index, personal spending, and the Michigan consumer sentiment on Friday. So again, a lot of economic activity coming out this week, a lot of housing data, GDP numbers. Obviously, people will be really looking at that core PCE number for, clues for the Federal Reserve coming in next week. But so a lot of economic indicators coming out in the following week. So what did some of the other economic indicators do this week? And what is some of the banking news that I have coming up for you guys? So let's go through some of it. So builder confidence remains steady in September. So the National Association of Home Builders Index of builder confidence in the market for newly built single homes remained at 32 in September. Retail sales up in August. Industrial production edges up in August. Business inventories were also up in July. Housing starts and building permits were down in August. Mortgage applications jumped last week. FedNow is delivering instant payments for disaster relief disbursements. So FedNow announces that participants recently started receiving instant disaster relief disbursements for their account holders. New York Fed survey, business declines in September. So business activity declined modestly in the New York State in September, according to a Federal Reserve Bank of New York Empire State Manufacturing Survey. The Senate did confirm Stephen Mirren, as obviously he was at the Fed meeting. Of course they did. Consumer sentiment drops in September. NACHA, my favorite acronym in the banking world, NACHA, to automate ACH audit-proof process. So NACHA announced that starting next month, the process of requesting proof of an ACH rules compliance audit will be automated through its risk management portal. That's fantastic. Okay, now the House Committee advanced this week a number of ICBA-supported bills. So the House Financial Service Committee voted to advance 5 ICB-supported bills designed to support community banks. So in a 51-0 vote, they passed H.R. 2234, which was sponsored by Rep. Tom Emmers, which would raise the percentage threshold for reciprocal deposits that may be held by a bank without being considered broker deposits. So again, that's great. In a vote of 28-24 to pass Rep. Scott Fitzgerald's Bank Competition Modernization Act, which would allow banking agencies to not request a Justice Department competitive analysis of a merger or acquisition application that would result in a bank with assets of less than $10 billion. So again, trying to help some of the M&A activity there for banks under $10 billion. In a 39-19 vote to pass Rep. Young Kim's Community Bank Lift Act, which would lower the community bank leverage ratio from 8 to 10% to 6 to 8% and allow banks with up to $15 billion in assets to use what's called the CBLR. In a 35-17 vote to pass Rep. Roger Williams' Merchant Banking Modernization Act, which would amend the Bank Holding Company Act to provide that merchant banking investments made through an affiliate or a bank holding company may generally be held for a period of not less than 15 years. And then finally, in a 49-2 vote to pass the Community Bank Deposit Access Act of 2025, the bill to allow custodial deposits to be held by community banks without being considered broker deposits, provided the custodial deposits do not exceed 20% of the bank's total liabilities. So again, some very interesting bills to pass through. Now, again, this just passed through House committees, so not the full House. So they got through committees, which means they're now going to go before the full House for a vote. We'll have to see if that goes. And then obviously if it gets through the House, then it has to go to the Senate before finally getting to the president's desk to be signed. So still a long ways to go, but some very good progress there. So what's some of the other stuff I have here? So the Fed Detect announces a new payment fraud tool. So Federal Reserve announced a new reporting feature for its Fed Detect anomaly notification for Fed ACH services, which helps financial institutions quickly address potential fraud. So hopefully so. Indeed, our input needed on FDIC proposal to raise index audit and reporting requirements. So the ICBA is calling on community bankers to submit comments on the FDIC's proposal to adjust and index certain regulatory thresholds, most notably Part 363 independent audit and reporting requirements. ICBA affiliates, agencies must act to support fraud mitigation efforts. ICBA and its 44 state affiliates said community banks continue to be challenged by a rise in fraud and scams across payment types, necessitating agency action. ICBA, AI can help community banks if regulated properly. So ICBA told Congress it believes artificial intelligence has the potential to help community banks meet regulatory burdens and expand access to credit, but thoughtful regulation is needed to ensure that innovation does not come at the expense of consumer protection or financial stability. So yes, interesting there. ICBA, community banks lead the fight against fraud. So ICBA told Congress that community banks are on the front lines of fraud mitigation and are leading the response, but cannot solve the problems alone. So in a statement for the record, prior to a House Financial Services Committee subcommittee hearing on fraud, ICBA said two types of fraud have become increasingly prevalent and can have crippling effects on victims: check fraud and the financial abuse of U.S. seniors, otherwise known as elder abuse. New or revised supervisory guidance that is particularly burdensome could impact community banks' ability to effectively prevent, detect, or mitigate fraud by forcing resources to be redirected. So we will keep an eye on some of that. Now, let me just say a couple things. Elder fraud is a huge problem in this country. All of us can help to do some things to help prevent elder fraud, which would be again just keep an eye on your parents' side. If you got older parents, keep an eye on your parents. If you got older aunts and uncles and grandparents and stuff like that, keep an eye on them. Make sure that they're not falling for tricks or scams, or there's not funny things going on there. If they start making sudden trips to the bank, maybe ask them a little bit, hey, everything okay there? Everything going all right? Because unfortunately that's what happens. A lot of these older people fall for a lot of these scams. On the check front, I think there are certain people in banking that would very much like checks to just go away, just completely disappear. Unfortunately for that, I would say probably not. I think checks are still very, very valuable in certain situations, particularly for businesses, particularly small businesses, in just moving certain amounts of money around every day. And there's still billions and billions of checks. I mean, there's still 13, 14 billion checks a year that get written a year or something like that. I mean, it's a lot of checks that get written and everything. What I would suggest for a lot of small business owners out there, if you have ever heard of Positive Pay, I would definitely go in and ask your bank if they offer Positive Pay. Positive Pay, I will tell you the downside. Two downsides to Positive Pay. Obviously, first is you got to pay for it. And I think some banks probably charge more than others, but probably looking at around, I don't know, 80, 90 bucks, maybe $100 a month for Positive Pay. Now you might be going, okay, $1,200 a year. Do I really need to pay that? Well, if you stop one $6,000 check from going through that was fraud, you basically paid for the $1,200 that you spent on Positive Pay. So one of the drawbacks is cost. You have to pay for it. It's an additional cost. The other drawback is it takes time because every check you write out, you have to put that into Positive Pay. And then what happens is, as checks get presented into the account, you got to go, every day you got to log into the system. You see the checks that are presented for the day, and you click on that. You go, boom, boom, approve. If you see one that's shady, decline. But that system is one of the best ways to prevent check fraud on your business. So if your bank offers Positive Pay, I highly suggest you go in and check it out. Okay, last two things here. So OCC announces ICBA advocated supervision restructuring. So following ICBA advocacy, the OCC announced it will reverse its ICBA opposed plan to merge its community, mid-size, and large bank supervision functions into a single unit. The OCC said it will retain three distinct supervisory structures for large and global institutions, regional and mid-sized banks, and community banks under $30 billion in assets to facilitate a tiered and risk-based approach to supervision effective October 1st. So great news there. Supervisory appeals. Reviewers should have community bank experience. ICBA told the FDIC that in revising the agency's supervisory appeals process, the FDIC should ensure that reviewers have significant community bank experience. In a comment letter on the agency's proposed guidelines for appeals of material supervision determination, ICBA said it preferred a Federal Financial Institutions Examination Council appeals office but supported the proposed enhancements to the FDIC's internal supervisory appeals process. So, okay, fair enough. We will keep an eye on that. All right, so real quick, let me get out of this. Bear with me for a second here because I need to share screen this. Okay, and I apologize if this is kind of tiny here, but what I wanted to do is I wanted to read this article for everyone for a second here because this was a really interesting article. So I think it makes some great points. All right, everybody ready here? So a funny thing happened at the end of 2007. On the brink of the worst downturn since the Great Depression, 2/3 of economists didn't see even a garden variety U.S. recession coming. The Fed had just cut rates 3 times in the past 4 months, after all, with more cuts on the way. The proportions were flipped in the Wall Street Journal's economic survey 3 years ago, when nearly 2/3 of respondents were expecting a recession to begin within a year. One didn't happen despite several Fed rate hikes in the preceding months and more in 2023. Predictions are hard, especially about the future. The point of digging through old ones isn't to make fun of economists, but to understand what wrong-footed them. Can the warning lights on their dashboard be ignored when the Fed is easing like it is now? Possibly the most relatable indicator of an impending downturn is the inverted yield curve. When the interest rate on long-term securities like the 10-year Treasury note is lower than that for short-term ones, then it signals an expectation of future rate cuts in response to coming economic weakness. Now, I talked very ad nauseum about inverted yield curve. I've done episodes on inverted yield curve that we've had over the last couple of years. So if you want more information on that, I definitely have that up there. But let's continue on. So since the 1960s, an inverted yield curve had reliably signaled recessions. One of those in 2019 was right on a technicality. Bond traders didn't predict the pandemic. The inversion that lasted from summer of 2022 through last summer was the longest ever. When it ended, some diehards pointed out that the downturn doesn't actually hit until the curve uninverts. Well, it's been a year and a recession hasn't materialized. Another previously reliable recession indicator, the ISM's index of U.S. manufacturing activity, was in contraction for a whopping 26 consecutive months through early 2025. It's now on a new 6-month contraction streak. The barometer tends to point down just as a recession is beginning. And finally, bear markets. Stocks nearly always enter one ahead of recessions, and they did so in 2022. Economist Paul Samuelson famously cast doubt on this indicator, quipping that the stock market has predicted 9 of the last 5 recessions. Why did most economists misread the last few years, though? One reason is that the bond market hasn't behaved normally since the Fed adopted powerful new tools in response to the financial crisis. Outright Fed bond buying and near zero interest rates pack a lot of punch and create distortions. What did I say earlier? Distortions, too. A bigger fly in the ointment might be government spending. Even with the economy growing, the federal budget deficit is at levels previously only experienced during sharp downturns when social and stimulus spending has flowed. The gusher of cash goes a long way. It also raises the question of how much dry powder Washington will have when warning signs aren't a false alarm and the U.S. really does enter a recession. So, very interesting here. He points out how, in 2007, none of the economists saw a major crash or an economic recession coming. And then, again, a few years ago, they thought that, the recession's going to come. And then the recession never really materialized. And then they talk about 3 particular things: the inverted yield curve. And they talk about the manufacturing activity and how that has been down. And then they talk about a bear market, which we haven't really seen, hasn't really materialized in the last few years. I mean, you might say the pandemic, but I think that was a total black swan type event. Now, why do I point all this out? Because typically you would look at all these things and you would say, oh, okay, these are all the predictors that we have historically used to try to recognize when a recession is going to hit. And this stuff is not really working in the context that it used to. My argument to this would be that if you understand how badly, and again, he used the word there, outright Fed bond buying and near zero interest rates, in other words, that was called ZIRP, zero interest rate policy, packs a lot of punch and create distortions. That's the key word there, distortions. I would say that over the last 16 years, the Federal Reserve has created monumental distortions in our economy to the point where a lot of this stuff, a lot of these indicators don't, I'm not going to say they don't work anymore, but they don't work necessarily maybe in the time frame we think they should, and they don't work exactly in the manner that they used to. And that's why I just wanted to read this to everybody tonight, because I thought it pointed out some very interesting things, and I was hoping to offer a potential hypothesis as to why I think some of these things don't work the way that they do. And that is, again, is because of the Federal Reserve, the distortions. Now, beyond that, you have a particularly egregious issue during the Biden administration of just the manipulation of data. You know, what Janet Yellen was doing at the Treasury to manipulate the treasuries to drive us into that inverted yield curve and then keep us in that inverted yield curve for a very extended period of time. That didn't happen by accident. It happened on purpose. We were intentionally put into that inverted yield curve by Janet Yellen. Okay, you're not going to hear that on CNBC, but that's exactly what happened. And and then, just the manipulation of the jobs numbers and inflation number. And oh, yes, inflation numbers were manipulated. I promise you that the inflation that was reported back in 22 and 23 was much higher than the 9% that it was. Did you ever go to the store and look at the prices on some of the food and sit there and think to yourself, this hasn't gone up like 5 or 6%. It's actually gone up like 32%, 40%. Yes. So when they give you this inflation number a few years ago of like, oh yeah, inflation's up 8-9% or whatever. No, the real inflation number was probably more like 16-17%, was probably more the real number. And again, I look at alternative sites such as like Shadow Stats to get that kind of information. I should really share the Shadow Stats stuff with you guys. I think people would really find John Williams over at Shadow Stats is an absolute legend. Love that guy. He's been doing it for a long time. MIT trained, just brilliant guy. And Shadow Stats puts out some great stuff. He with the CPI, for example, he uses the actual calculation from 1980. He doesn't use the calculation they use today. He uses the original calculation, and when you use the original calculation, you get a much different inflation number. So again, just looking at those things, you talk about just manipulation, distortion by the Fed. I think that has affected a lot of these economic indicators that we have historically looked at and put faith in to try to give us some guidance as to what was going to happen. So now, is it possible that some of these things come back? I think it does. And he raises an interesting question there at the end of that article where he says, how much dry powder Washington will have when warning signals aren't flashing a false alarm and the U.S. really does go into a recession. Now, I don't hope we have a recession anytime soon, but I know as the sun comes up, as guaranteed the sun will come up tomorrow, someday we're going to have another recession. And I think a big thing depends on what's called the moral hazard. How does the government react to some of these things, and how do we continue the policy of endless bailouts? That's the $1 million question, if you will. All right, guys, I want to get into this for a minute. This is how people actually use ChatGPT, according to new research. So what do people actually use ChatGPT for? It's a question that has lingered since the tool first went viral back in 2022. Now, a new research paper from OpenAI sheds light on user behavior by analyzing a sample of 1.1 million messages from active ChatGPT users between May 2024 to July of 2025. The findings, summarized by Visual Capitalists, is a helpful visualization by Made Visual Daily, show that ChatGPT's core appeal is utility, helping users solve real-world problems, write better, and find information faster. So what do people, and let me see if I can I make this a little bit bigger here so people can actually see this? So, okay. So what are people using this for? So practical guidance, 28.3%, writing, 28.3%, seeking information, 21.3%. I would say I definitely fall into the seeking information category. I love to use Chat GPT for the simple things like, how many home runs did Babe Ruth hit in 1930? If I'm trying to remember like certain things about a scandal or something like that, I might type in, hey, tell me about this bankruptcy happened or this scandal happened with this bank in 1985. Can you tell me a little bit about that? Like that. That's what I use. I would say ChatGPT the most. I really, as a writer myself, I really try not to use ChatGPT. I like to use things like Grammarly, even though Grammarly has dumped in its own AI, honestly, into their program more recently. But I love Grammarly if anybody ever uses that. And then technical help, 7.6%, multimedia, 5.9%, other unknown, 4.5%, and then self-expression, 4.3%. Now, on the other side of this equation here, asking for specific information, 18.3%. And that, again, that would be me. I would be falling into that. Edit or critique provided text, 10%. Tutoring or teaching, 10%. How-to advice, 8.5%. Personal writing or communication, 8%. Health, fitness, beauty, etc., 5.7%. That's kind of interesting. Translation, creating an image, computer programming, other unknown, creative ideation, argument or summary, only 3.6%. Mathematical calculation, 3%. Punctuation products, purchasable products, greetings and chit chat, relationships and personal reflection, 1.9%. And then you got a lot of really tiny ones here. Write fiction, generate or retrieve other media, cooking and receipts, analyzing an image, asking about the model, games and role play, data analysis. So again, just some very interesting things there. And then it says here, like over 55% of ChatGPT prompts fell into either learning or productivity related tasks. Users often turn to the chatbot for help understanding concepts, writing emails, summarizing articles, or coding. A wide base of users are using the tool as a digital assistant, tutor, or research aid. Meanwhile, niche categories like role-playing and entertainment make up a smaller but meaningful slice. These users include things like fictional storytelling, game design, and writing fan fiction. Their growth points to ChatGPT's creative potential beyond functional tasks. And then why this study matters. Well, this is the first large-scale analysis that classifies how ChatGPT is actually used rather than relying on anecdotal evidence or surveys. It also reveals how people across professions, from marketeers to software developers, are integrating AI into their daily workflows. Another key insight: most people still use the free version of ChatGPT. Yeah, it's me. Only about 10% of the prompts analyzed came from paid users of GPT-4, suggesting that even the free tier model is driving widespread productivity. So, yeah, so again, very interesting. I think we'll have more on this. I've done a couple of episodes that are called like AI updates, where I just focusing on kind of AI in primarily, business and financial services, because that's my niche, my shtick here on the channel. But there's something with AI that is some really disturbing stuff. And I've got a few articles on that I'm going to get into. And then, I don't know if anybody saw it. Sam Altman did an interview with Tucker Carlson. And if anybody has not seen this interview, I highly recommend you go watch this. This is a wild interview. And one of the things that came out that I was shocked with was how many people are using ChatGPT for suicides. And that again, when he talks about that, it's just wild. And the only reason I mention that is because it does play into some of the articles that I'm going to share when I get into and do my next like AI update. So hopefully people, again, I thought this was really interesting. That's why I wanted to share it with everybody, but hopefully people maybe learned a little something out of that. So, okay. Very interesting thing here. So Trump, and I think I reported on this last week. I think I did. So Trump advocates to end quarterly earnings reports. And I did report on this last week because if you remember, what I said was that I thought this was a good idea, but I also thought that Trump was going to get a tremendous amount of pushback on this. And the reason why I said that is because the business press, the CNBC, Bloomberg, Fox Business, they have made basically a cottage industry within, their programming on quarterly earnings. It's earnings, CNBC, it's earnings season, got to report those quarterly earnings, make sure to tune in after the bell to get, Meta is going to drop their earnings right after the bell. So you got to be here to see what hits, right? Like they gear everything every 3 months around earnings season, and they make a big deal of it for a week. And I really don't think they want that to go away because that's gonna hurt ratings. So anyway, so Trump floats this idea. Then Scott Bessent comes out and basically say Trump's push to scrap quarterly company reports will be a win for investors. And yeah, I don't disagree with that. I think he's absolutely correct because I think it would save and would save a lot of companies a lot of money. But then here comes the pushback. So why Trump's bid to end quarterly earnings is no sure bet. The SEC is prioritizing Trump's proposal to allow companies to report twice a year. Many might still continue frequent reports. So President Trump wants to eliminate the requirement for public companies to report earnings quarterly, suggesting twice a year reports. But again, he's getting already pushback is coming back. All right, but let's go to the next one here. So, and then all the reasons Trump would be wrong to ditch quarterly earnings. Companies can happily invest for the long run while reporting quarterly. Just look at today's economy. So, and again, now he's making the argument here like, oh no, we don't need to cut. We don't need to do that. We don't need whatever. I personally think that companies should be able to choose. I think that companies should have the choice. I think that there are a lot of smaller companies that do operate more on a long-term basis. And those smaller companies in the S&P 500, or maybe the Russell 2000, whatever. I mean, again, if they don't want to or need to particularly report every quarter, why should they have to incur the expense to do so? Like, why can't they just report every 6 months? And again, I think companies should at least have the ability to choose, how they want to report their numbers, and hey, look, if they go to a 6 month schedule and then after a year or two, people are complaining about it, their stock price is getting beat up a little bit, or people don't like it, whatever, then they can always go back, right? They could always revert back to the quarterly reporting. So I don't know. So it's just interesting. But like I said, last week when I first reported on it, I thought it was a good idea. I thought it would help some companies save some money. But I also recognized, the kind of the bigger picture of what was to come there. And I felt like, he was going to get pushback on this. And sure enough, the pushback came. But the SEC is putting this forth. So, we'll see what happens. We'll see how that pans out. So and then right here, SEC to propose rule change on Trump's call to end quarterly earnings reporting, says Chair Atkins. So again, they're moving forward with that. So we'll see what happens. So, okay, TikTok. I was watching this very closely this week. So we started out at the beginning of the week, TikTok deal to include new investors with ByteDance, Oracle to keep cloud agreements, sources say. So the upcoming framework agreement for TikTok will include new investors and existing investors in ByteDance. Sources told CNBC's David Faber the deal is expected to close in the next 30 to 45 days. Congress passed a bill last year that would ban TikTok unless its Chinese owner ByteDance divested from it. Then we also got Oracle and Silver Lake are part of the TikTok investor group as Trump extends the deal deadline. So President Trump on Tuesday extended the deadline for ByteDance to divest TikTok's U.S. business, which will be owned by investor consortium that includes Oracle and Silver Lake. The Wall Street Journal reported that under the framework deal, about 80% of TikTok's U.S. business would be owned by those investors, as well as Andreessen Horowitz. It's the fourth time Trump has extended the deadline, keeping TikTok from having to effectively shut down in the United States. And then we got to today, where everybody was kind of on pins and needles, like, oh, what's going to happen here? Are we going to get a deal finalized, whatever? So after waiting all day, it gets reported that Trump and Xi have made progress on the TikTok deal, but more work remains, the White House says. So President Donald Trump and Chinese leader Xi Jinping held a much anticipated call aimed at finalizing a deal to keep TikTok from going dark in the U.S. ByteDance, TikTok's Chinese parent company, has faced an ultimatum under a federal law requiring it to either divest the platform's American business or be shut down in the U.S. Trump has repeatedly extended the deadline. So, do you want me to take a guess on this one? Do you want me to venture to see basically what's going on there? I would say that the real argument here is over the algorithm. That's what I would say, because I would say that what they want is for Oracle and who else is it? I'm trying to, you got what was it? Oracle and Silver Lake. Thank you, Silver Lake. So my guess is that Oracle and Silver Lake want to take it over, but then they want to put in, kind of their own mix into this thing. They want to put their own little sugar and spice in the sauce, if it will. And my guess is that China does not want to do that. That even though they're selling 80% of this, they still want to keep the same algorithm so that they can and this is the big issue with using TikTok. They want to siphon that data. They want to siphon all your data off of your cell phone and off your laptop and off your hard drive and off your not hard drive, but your PC. That's what China wants to keep doing, and I'm betting behind the scenes that is in fact the argument. But like I said, we'll keep an eye on it, and we'll continue to see what happens. So progress made. I think that David Faber reporting on CNBC that they were probably going to close this deal in 30 to 45 days. I would suspect that is mostly true. I would say they probably have 80% of the deal hammered out. I think they're probably stuck on this last 10-20%, which I think is really based around the algorithm, but we'll see what happens there. Okay. This was really interesting. So China says NVIDIA violated antitrust law. So regulators' move against chip company comes during Washington-Beijing trade talks. Now, I was going to give everybody a little bit more tariff news tonight, but but with the other stuff I want to share with you guys, I just didn't have enough time for it. But yeah, this was really interesting. So if I could give the background on this, because this goes back a few weeks, but what happened was, so first, NVIDIA had this thing called the H20 chip, and NVIDIA was selling the H20 chip to China. We didn't, all of a sudden the government said, no. U.S. government said, no, you can't sell that chip to them. They put restrictions on it, and then they opened the chip up. And then, so then NVIDIA started selling the chip back to China. Now, when the chip went back to China, China looked at it and said, whoa, dude, you guys built in a whole bunch of what are called backdoors and all different kinds of security things into the chip, which I'm sure the U.S. government asked them to do. and basically, China looked at it and said, no. And then China started telling everybody, like, do not use these chips because there are major security concerns with using these chips. And just like we have major security concerns with using anything from Huawei, Huawei security cameras and stuff like that. So it's kind of like this tit for tat thing going on right now with this. But it's just interesting that, China is really beating up on NVIDIA right now, especially it's not helping the trade talks, as it were. So Okay. All right. So I got about 10 or 12 more articles here that I wanted to run through, but I think we can run through these. If you guys will hang with me for about 10 more minutes here, I think we can run through all these pretty quickly. This I thought was really interesting. Kroll and Stepstone Group create private credit benchmarks service. So they're offering through Kroll lets investors use a database developed from over 15,000 transactions. Now, I have talked a lot about private credit. I've talked about the ballooning of the private credit market. I have talked about why I think that there is a major concern in the credit market. If I was a betting man, which I'm not, and I would say that there is a part of the economy that could blow up, it would be the private credit market. That private credit market worries me. It worries me a lot. So, but this company basically is, kind of creating this database to basically benchmark and analyze a lot of the deals and the loans that are running through the private credit market. I would say this is probably something that is much needed given the growth and size of the credit. The private credit market is now over $2 trillion. So it has ballooned in the last 5 years. And I think that's part of the issue is how fast it has grown and how much banks have basically tried to offload their risk into the private credit market. It's a big problem. But these guys created this database with these benchmarks. So again, pretty interesting stuff there. We'll keep an eye on that one. Companies kick off September with a deluge of bond sales. So prospect of falling rates has boosted investor confidence for corporate debt. And this was on September 7th. So rate cuts are on the way and U.S. companies are borrowing billions of dollars. So American corporations, including Merck and Ford Motor, opened September with a wave of debt sales, issuing around $56.4 billion of investment-grade bonds through Thursday this past week, along with about $9.6 billion in junk bonds. So again, very like to see it, healthy bond sales to kick off the month of September. That's great. The Wall Street's run it hot trade powers stock records. So the Federal Reserve is expected to cut rates this coming week, and some are betting on a new burst of economic growth. So the coolest trade on Wall Street is known as the run it hot. So while slowing job growth and tariff-related costs remain primary concerns for investors, the core of the trade lies in betting on an economic resurgence, not a recession. So the thinking, tax cuts and falling interest rates will heat up the economy, fueling a new burst of growth. Yes. What I've been saying. Yes, absolutely. That line of reasoning has sent all manner of investments to records, from stocks to Bitcoin to gold. Even if the labor market weakens further, many investors believe the near-term outlook remains bright, which they expect to fuel further gains across markets. We've got an economy that's still growing, said Nielsen Yu, head of equities at active asset manager Alliance Bearstein. It's not falling off a cliff, and I think it actually should be a pretty good environment for risk assets if the central bank can start cutting rates, which they are. So again, I like this idea of this running hot trade. Basically, tax cuts and falling interest rates will heat up the economy, fueling a new burst of growth. But it's not just that; it's the reinvestment in America. That is what ultimately is going to be the tax cuts and the falling interest rates. That really helps. But the secret sauce here is going to be the job creation. That is always what the secret sauce is. Always the job creation. Cutting taxes and falling interest rates, those are stimulants to the economy, to be sure, but they're like kind of like sugar highs. They give the economy a little burst or whatever. Long-term growth and strong economic activity is always rooted in the labor market. It's in the jobs, the creation of good paying jobs that provide strong wages that enable people to start families and get mortgages and buy cars and send kids to school and do all that good fun stuff that we love to do year in and year out. So, and I think that the job market over the next couple of years is going to be very robust. So we shall see there. Okay. Gold hasn't rallied this much since 1979, baby. A 40% price jump this year outpaces COVID-19 pandemic, 07-09 recession. So investors are flocking to gold amid economic uncertainty spurred by the Trump administration's policies and trade tensions. Kenneth Pack invested in gold for the first time in April to shield himself from what he saw as the disorder of the new Trump administration. The chaos trade was just heating up. So, again, okay, fair enough. If somebody sees the economy that way, I don't really see it that way. I see it more a hedge against, inflation and just the massive, colossal failures of the investment bank. I see, or not the investor, the central bank rather. I see it more along those lines. But okay. But no doubt, I mean, gold has just been on a phenomenal ride. And the irony of all this. Do you know who is the biggest purchaser of gold? It is the central bank. Not just our central bank, but all the central banks around the world. They are the biggest buyers of gold. Okay. They have been on a gold buying binge for the last, 6-7 years. And that is what, again, it's the purchasing by the central banks. That is what's really driving that upshot in the gold price. So just keep that in mind. It's just something to think about. Labor prices are flashing a warning sign for the U.S. economy. So wood prices are sliding and mills are cutting back because of uncertainty over tariffs and a building slump. So lumber futures have dropped 23% since early August, ending last week at $535 per 1,000 board feet. So falling lumber prices are sounding an alarm on Wall Street about potential problems on Main Street. Wood markets have been whipsawed of late by trade uncertainty and a deteriorating housing market. Futures have dropped 24% since hitting a 3-year high at the beginning of August and ended Monday at $526.50 per 1,000 board feet. So again, here you're seeing this massive drop off in lumber prices. I think there is a little bit of concern here with the weakening in the housing market, as it were, in terms of new home construction. I actually think this is probably a good thing, though, because this is, again, you want the cost of houses to come down, right? Well, obviously, a lot of lumber gets used in the building of houses. So the cheaper the lumber, the better that's going to be for home builders actually building houses going forward. So again, I think you can look at it like, yeah, it is a little bit of a concern. You want to keep an eye on it. I don't think it's so much tariffs. I think it's more just a weakening of the housing market. But again, I'm hopeful that price continues to come down and that it will, help reduce the cost of building houses, which will hopefully lead to maybe a little bit of a bigger building boom in the months and years to come. So, okay, let's look at a couple of real estate related articles real quick here. Home buyers are gaining leverage, but the minimum income to buy is surging. So Americans now need to earn $114,000 per year to afford a median-priced home. San Jose, California, reported the highest income requirement at $370,000. Rust Belt cities offer most affordable housing in the country. So just very easy, very very interesting thing there. This was more local to my area. Value of Philadelphia's housing market swells by $42 billion, the third largest gain in the nation. Zillow finds. Yes, not parts of Philadelphia, but the collar counties around Philadelphia, parts of South Jersey. The prices have just, they've exploded, and you can see this. We had the third highest gains in the country. Median home sale prices in Philadelphia hit a record high in June. Low inventory and building slowdown contribute to Philadelphia's rising home values. Yeah, I would say absolutely. And again, not that everybody cares about this. I'm just trying to give people a flavor for like what's going on in the real estate market. But one of the very interesting things that happened in our market was during COVID. So during COVID, because of the lockdowns in the city of Philadelphia, you had probably 500,000 or 600,000 people that left the city and moved out to the suburbs, all the counties around Philadelphia. And they saw part of this in South Jersey too. And that massive demand from all those buyers flooding into the market massively drove up prices. Because very low inventory, very high demand. And I saw things that I have never seen before. I saw, people overpaying for houses. Like a house goes on the market for 500,000, people paying 600,000 for it. I mean, cash. Like it's just, just waiving everything under the sun, waiving mortgage contingency, appraisal contingency, inspections, like just waiving everything, buying the house sight unseen, like just wild stuff. But then also you had a whole bunch of people like from New York move down to Philadelphia because it was, and Boston too. We had this influx, mostly people from New York, but we had this influx of people from like Boston and New York, and even some people from DC coming to Philadelphia because it was so much cheaper than many of those other East Coast cities. So just maybe some tidbits that people might find, interesting there. Philadelphia's post-pandemic job growth hasn't lifted the center city office market. Again, kind of a local thing, but I think also a trend that might relate to many other cities around the United States. So Philadelphia's job growth ranks 8th among large metro areas since 2020. But the office sector growth remains stagnant despite overall employment gains. The Center City District recommends economic incentives to boost office demand. So even though, growth has been pretty decent, job growth, it has not translated into helping the office market that much yet. Avison Young CEO, rate cut could be a shot in the arm for commercial real estate. Yes, I don't disagree there. Lower interest rates would boost investor confidence in commercial real estate. The office sector probably has the most to gain from lower interest rates. Some assets still face headwinds that had little to do with interest rates. Yes, that's true. Just, general occupancy, tenants, whatever. A lot that could happen there. But, and again, quarter rate point cut, is that really going to is that changing the world? Is that really, heating up the market? No, it's not. But if we get a few more rate cuts, if we get rates down 75 basis points, 100 basis points, and all of a sudden you go from commercial rates in the 6s down into the 5s, that is going to make a major difference. So you will start to see a big pickup, I think, in a lot of deals and a lot of activities. And then finally, my last real estate related article here for the night is profits on home flipping are falling, but some areas are beating the odds. So home flippers' profits shrink due to high home prices. ATTOM reports a lowest return on investment since 2008. Georgia cities dominate top areas for home flipping. So home flippers are seeing their profits shrink dramatically, plummeting to the lowest point in years. The latest report from ATTOM, which provides property data and analytics, found that home flippers netted a 25.1% return on investment before expenses in the second quarter, the lowest margin has recorded since the second quarter of 2008. It's also down from a high point of 62.9% in the fall of 2012. The culprit? High home prices that push flippers to buy in at a higher cost, squeezing margins and trimming profits. So again, just something interesting I thought to point out there, just to note. So home flippers getting squeezed a little bit as well. So, okay, a couple more bank-related articles. I thought this was interesting. Elon Musk's wealth took a historic hit. The staggering numbers behind his record loss. So wait till you hear this. His loss, which was on paper and due primarily to a drop in Tesla's share price, amounted to nearly $200 billion. Since that time, Musk has recouped his losses and is believed to be the world's richest man by a considerable margin. But I mean, try to wrap your head around that. He lost $200 billion. Like, wow, that's a bad day, right? That is a bad day. Holy cow. That's amazing. So like I said, just wanted to point that out because I just thought that was wild. Okay, a couple more things here. So the CEO of PNC Bank, he wants to double the size of his bank to $1 trillion. So Bill Demchak is on a mission to challenge the likes of JP Morgan. So they just, PNC just pulled off the biggest acquisition, or just announced the biggest acquisition of the year. So good for them. But you can see here, they're still, way below. I mean, obviously you've got JP Morgan Chase approaching almost $4 trillion in assets at this point. I mean, they are the biggest, baddest bank in the land. Bank of America here with about probably 2.5, 2.6 trillion in assets. Citigroup, approaching probably about 1.7 trillion in assets. Wells Fargo not too far behind, about 1.6 trillion in assets. U.S. Bank Corp, Capital One, Goldman Sachs, PNC, they're all in that bucket of 500-600 billion in assets, but not quite up to a trillion. So PNC, they may want to double the size of the bank. They might want to try to compete against JP Morgan, but they still got a long ways to go. So we will see. We will see what happens there. But yes, Mr. Jemchek is a very ambitious individual there. So old IT systems weigh down bank modernization. So banks are struggling to differentiate their digital products due to outdated tech, clearing the way for customer churn. So outdated technology is causing banks to lose customers, according to a survey published Monday from consulting firm Baringa. The company surveyed 4,000 U.S. and U.K. residents with bank accounts and 400 U.S. and U.K. bank leaders about the digital customer experience. Legacy technology architecture slowed modernization and hurt customers' digital experiences, according to 68% of IT leaders and banking executives. Meanwhile, 62% of customers switched or have considered switching banks to find a better digital experience and product from their bank. 2/3 of bank leaders estimated that some of their oldest programming code was written prior to 2000. Nearly 1/3 of banks' oldest technology infrastructure, including systems such as payments and transaction processing or call center support, dated back to the 1960s or earlier. Yeah, they're not wrong. But I would just remind people that the articles like this have a tendency to be overblown. So don't read too much. These banks aren't bottoming out tomorrow, but it is a concern. It's always a concern, and you just have to understand that it is massive for banks. People have no idea the amount of technology and vendor contracts. The typical bank probably has 400 to 500 vendor contracts. I mean, it is a lot. It's a lot. And there's a lot of money, a lot of cost that goes into that. Those vendor contracts are very sticky and very expensive to get out of. It's not as easy. You can't just, flip a switch and turn it off or turn it back on. Okay, Fed lifts the FedNow limit to 10 million. As financial firms flock to instant payments, the Federal Reserve has pitched FedNow as a way to ease internal transfers, corporate payroll, and big transactions. So the Federal Reserve will raise the FedNow instant payments transaction limit from 1 million to 10 million in November. The agency announced Tuesday the higher limit allows financial institutions to customize transaction sizes for their own operations based on their internal risk and business needs, the release said. The FedNow has signed up 1,400 U.S. banks and credit unions to use the real-time payment service for faster payments in the U.S., according to a press release from the Federal Reserve. So yes, so we will keep an eye on that. Let's see here. Ally CEO, pace of tech change weighs on me. So Sashish. I'm just going to say Sashish. The bank's chief information data and digital officer shared what surprised him about the use of Ally's AI platform and the challenges of rapid tech evolution. I'm not going to get into all this, but again, it kind of plays into the theme of what I just reported on with about the fact that they have a lot of people, a lot of costs. It's not easy to deal with compliance, audit, privacy, all these different things, and keep the customers and everybody happy at the same time. So I understand what he means by it weighs on me. It weighs on all of us in the banking business. So, and then finally, last article of the night, BOA, Bank of America, is boosting the minimum hourly wage to $25. So the Charlotte, North Carolina-based bank followed through on a 2021 promise to raise its pay floor to that level. And it's not the only U.S. lender to do that this year. Bank of America is boosting its minimum wage to $25 per hour. The Charlotte, North Carolina-based lender said Wednesday. The increase takes effect next month. So with the move, the bank reaches a long-held goal to provide a $25 minimum hourly wage by 2025. The increase puts the minimum annualized salary for full-time employees over $50,000, the bank said. So, good for Bank of America, and I'm sure that a lot of other banks will be following suit. This is not going to help your smaller community banks in the country that really can't afford to pay people $25 an hour. But, we'll keep an eye on it and we shall see what happens. So, okay. So, hey, I want to give a shout out, Samson. How you been, brother? How you doing, Samson? Haven't seen you in a while. Glad to see you back on here. So just a little shout out to him. Samson had recommended a topic for me a while ago. I'm trying to remember off the top of my head what that topic was. I think it might have been on GSEs. I think, Samson, if you remember, I think it might have been on GSE. So I did end up doing that episode for him. So little shout out. Thank you for joining us here tonight. All right, what am I looking here for? Okay, I don't have. All right, so I want to do to wrap up, I want to do my story of the week and I want to do my quote of the week, but I also have my little things here that I like to read. Okay, so if you're following the podcast on Apple Podcast or Spotify, please be sure to leave me a review, as that really helps the podcast. Make sure to visit thebankernextdoor.com. A lot of great things on the website. Make sure to subscribe on YouTube to get the latest updates via post. Like for this week is a perfect example. I had to move the strategy room from Saturday night to tonight. So I put that out in a post over the last couple of days, just letting people know, hey, I moved the date and time. So, make sure to come on and follow me here. And like I said, that's why I make sure to subscribe on YouTube if you want to get those most up-to-date posts. If you have a comment, a question, or if you'd like to recommend a topic, you could send that to me at info@thebankernextdoor.com. So any questions like that, anything like that, info@thebankernextdoor.com. You can follow me on Getter, Truth Social, and X. BND is on YouTube, Rumble, and all major podcast platforms. New episodes air every week, Monday through Friday, premiering at noon. And BND Strategy Room, obviously, hopefully, usually every Saturday night at 8 p.m. So that being the case. Okay, so now let's go to our story of the week. So last week I did the FOMC meeting, the Federal Open Markets Committee, and I'm going to keep on that track we're going to cover the Beige Book. So the Beige Book is a report produced and published by the U.S. Federal Reserve. The report referred to formally as the Summary of Commentary on Current Economic Conditions is a qualitative review of economic conditions. The Beige Book is published 8 times each year before meetings held by the FOMC and is considered one of the most valuable tools at the committee's disposal for making key decisions about the economy. The book outlines conditions of the national economy, the pace of business activity, and employment and hiring conditions in each of the 12 regional districts, based on interviews with local business leaders, economists, and bankers. So that is the Beige Book, which is a very followed item. Comes out after every Federal Reserve meeting, so people could kind of get a better feel for what was discussed and what's going on and what was the information that the Fed used to ultimately make their decisions. So okay, and then our quote of the week. So I was obviously with I talked a little bit about what happened with Charlie Kirk last week. And it just, I don't know. I've been thinking a lot about the Lord of the Rings. I love the Lord of the Rings, a huge Lord of the Rings fan. And I was thinking about the conversation that Frodo has with Gandalf in the first Lord of the Rings movie, where, Frodo's kind of complaining about, I wish the ring had never come to me. And Gandalf says to him, so do all those that live to see such times, but it is not for us to decide. And then here comes the quote. All we can do is decide what to do with the time that is given to us. And that is just something that's been stirring around in my mind. It's something that is a quote that has stuck with me for a long, long time. All we can do is decide what to do with the time that is given to us. And that is so true for all of us, and make the most of the time that you have out there. All right. That being said, thank you so much for hanging out with me tonight on this Friday night. I hope everybody has a great weekend. Again, look for new episodes from the Strategy Room next week, Monday through Friday. We will be back same time, 8 o'clock. It will be, again, hopefully back normal time Saturday night next week. Until then, have a great time, a great weekend out there. Thanks for listening, and I will see everyone again real soon. Thanks a lot.